Good afternoon from Oanda, Asia. This is your weekly roundup of the financial markets and things that are catching my attention. And this week, my attention is almost entirely focused on the US non-farm payrolls on Friday evening. It will be the major data point of the week, and it's really going to give markets an idea of the pace of the US economic recovery. We saw a few blips earlier in the week. Factory orders, transport missed slightly. US ISM manufacturing PMIs, purchasing manufacturing indices also missed slightly. But otherwise, all the data is saying that the US recovery is on track. The missing part of that equation is employment, with 8.5 million Americans still out of work from pre-pandemic levels. This evening, we actually have a sub data point, the ADP employment. That's also from the US. That is predicted to rise by about 800,000 jobs. It's often used as a predictor for the non-farm payrolls. Hasn't been that good of late. But if we do see an 800,000 print tonight, we may see US bond yields start to rise, and we may see more strength in the dollar. The dollar actually rose last night after Janet Yellen actually carelessly said that interest rates may have to rise in America to rein in the inflation from increased government spending. Tech stocks in particular took a hiding from this. And if we look around at technology stocks, actually, we look at the first chart that I'm seeing here today. It's the Nasdaq. And I guess out of all of the three indices, this is the one that's making me the most nervous and is perhaps the most vulnerable to a rise in interest rates on Friday if the US non-farm payrolls print above 1 million jobs. And that's the key number here. We can see that the Nasdaq is in a rising triangle. It has resistance around 14,100, just below market levels, and it has support at around 13,250. It's 100-day moving average and the base of that triangle. Now, if the Nasdaq was to close below there on Friday, that suggests that we've got another 1,000 points of downside. Now, tech stocks, as we know, are the biggest beneficiaries of the 2020 Zoom boom, and thus they are probably the most vulnerable to investor nerves, such as their elevated levels. But if we look at the S&P and the Dow Jones, well, the picture isn't quite so nerve-wracking there. The S&P 500 is at all-time highs, but it does have more breathing space. It is around 4,200 at the moment, but it would really have to fall through 3,900, which is around its 100-day moving average, and also perhaps do some work around the 4,000 level for me to start getting nervous. So the two key supports there are 4,000 followed by 3,900, but it still has plenty of room to breathe. Similarly, the Dow Jones is at record highs, and it's beating up against resistance at around 34,300. But as we can see from the chart, it actually is still quite noticeably in a bull trend. And given that the Dow Jones is full of cyclical stocks, it is best placed to benefit from the US recovery. Cyclical industries have underperformed all over the world during the pandemic for obvious reasons, but they are very well placed to outperform if the global economic recovery continues at the pace that it is continuing at the moment. Finally, I want to talk about oil. I do like throwing a few curveballs in on my little ditties because we only have 5 minutes. Now, oil is behaving very interestingly this week. So on Monday, the dollar fell, but oil rallied. Yesterday, the dollar rallied, but oil rallied as well. So the oil market seems to have disconnected itself from the direction of the US dollar. And that tells me that the bullish momentum is building. And when we look at the WTI chart in particular, we can see that it is in a parallel upward channel. And a close above $66.50 a barrel says to me that oil, or WTI in particular, is going to target $71, and it might do so quite quickly. Well, that's all we have time for this week. Thanks very much for tuning in, and I wish you a profitable trading week ahead.